A $3 billion lifeline vanished in a matter of days. When a pillar of global finance of this magnitude falters, the shockwaves are felt worldwide. The critical question is what this means for the United States, for China, and indeed for the international economic order. This is an analysis of one of the most significant financial shifts of our recent times. We will examine why a substantial portion of US government debt is losing its foundational support. We will go beyond the headlines to uncover the real story behind the numbers and how this instability could ripple through global markets, with tangible consequences for ordinary people. The facts are these: foreign holdings of US Treasury bonds have undergone a quiet but profound change in 2025. One of the world's largest holders has significantly retreated from its former position. This is not merely a statistical blip. It is a direct indicator of shifting stability, waning confidence, and a potential reordering of global finance. Furthermore, we will identify the converging forces, economic, political, and strategic, driving this retreat. And we will address the pivotal question of why the United States now finds itself in a position where it may need to seek cooperation from its primary strategic rival. Let me be clear. This is about far more than debt. This is about trust. It is about power. It is about the recalibration of financial alliances. At the centre of this storm is Scott Bessent, who took office in early 2025 as the 79th U.S. Treasury Secretary. A veteran of global finance, with decades spent managing hedge funds and advising major institutions, Bessent now commands the entire financial machinery of the United States government. His mandate is to steer the national economy, manage the federal debt, and safeguard the system against global shocks. The so-called Treasury Lifeline is the massive web of debt and liquidity that underpins the US economy. The government raises money by issuing bonds, which are traditionally bought by foreign governments, central banks, and global investors. This provides the US with operational funds, while offering buyers a safe, liquid asset backed by the world's largest economy. This foreign participation is crucial. It keeps demand strong, interest rates low, and confidence high. Historically, China has been a cornerstone of this system, holding well over $1 trillion in US debt. It acted as a key anchor, but that has changed. Over recent years, China has systematically reduced its position. As of early 2025, its holdings have dropped to a fraction of their peak. While other foreign entities have stepped in to fill part of the void, this strategic shift by Beijing is what matters. When a buyer of this scale retreats, the stability of the entire structure is called into question. The US must now find new buyers, a task that falls to Bessent and his team. This is no longer simple debt management, it is a high-stakes strategic challenge involving shifting alliances and profound economic uncertainty. These bonds are now a barometer of global trust in the United States. The data is stark. From a peak of over $1 trillion, China's holdings have fallen to approximately $760 billion. By July 2025, reports indicate a further decline to around $730 billion, the lowest level since 2009. Crucially, this retreat is occurring even as total foreign holdings of US debt reach record highs. The message is clear. While others are still buying, China is consciously stepping back. The implications are substantial. Reduced demand from a major buyer means the US government faces higher borrowing costs. As bond prices fall, their yields rise. And because Treasury yields are the benchmark for the entire economy, this pushes up interest rates on everything from mortgages and business loans to consumer credit. But beyond the financial mechanics lies the greater risk, a crisis of confidence. US Treasuries have long been considered the ultimate safe haven asset. When a holder of China's stature pulls back, that perception is fundamentally weakened. If global investors begin to question the safety of US debt, they may seek alternatives, other currencies, gold, or different sovereign bonds. This, therefore, is not merely a number on a spreadsheet. It is a signal of shifting global priorities and a more precarious foundation for US debt. For policymakers and investors alike, the landscape is changing. The consequences will extend far beyond the trading floors of Wall Street. In early 2025, a high-level call took place between US Treasury Secretary Scott Bessent and China's Vice Premier He Lifeng. The subject, the increasingly fragile state of economic and trade relations between the two superpowers. On the agenda were the critical issues of our time: significant trade imbalances, retaliatory tariffs, and mounting economic pressure. The tone, according to official readouts from both the U.S. Treasury and major financial publications, was not merely diplomatic, it was urgent. From Washington's perspective, the motivation for this diplomatic outreach was clear and strategic. Secretary Bessent's concerns extended beyond immediate trade spats. He emphasised the risks to global economic stability should China continue its two-pronged strategy, trimming its holdings of U.S. Treasury debt and escalating tariffs. The core U.S. interest is the uninterrupted flow of liquidity. Put simply, the American government requires strong, consistent demand for its debt to fund its operations. A drop in that demand directly translates to higher borrowing costs for the United States. This in turn would not only destabilise government financing, but would also trigger a rise in interest rates for mortgages, corporate loans, and consumer credit across the economy. Simultaneously, the US aims to prevent a fresh wave of global economic instability. With financial markets already nervous, a public rift with Beijing risks undermining the foundational confidence in US debt as the world's premier safe haven asset. Therefore, pressing China, historically one of the largest foreign holders of US debt, to remain engaged is a direct attempt to preserve stability, reassure international investors, and maintain manageable borrowing costs. Analysed against the backdrop of China's steady sell-off of US Treasuries, these talks appear less as routine negotiations and more as an urgent appeal, a strategic move to shore up support before the situation deteriorates further. This situation, however, is not solely driven by Sino-American tensions. Beijing has been methodically executing a long-term strategy to reduce its dependency on US dollar-denominated assets. For decades, China relied on US Treasuries as a safe, liquid place to park its vast foreign reserves. Now, it is actively diversifying into non-treasury bonds, other currencies, and tangible assets like gold. This deliberate shift allows China to spread its risk, bolster its financial sovereignty, and insulate itself from potential global economic shocks. Compounding this strategic pivot are China's own substantial domestic economic challenges. The nation carries a heavy debt load across government, corporate, and local authority sectors. Its property market, a key pillar of the economy, remains in a prolonged downturn, characterised by developer defaults and stalled projects, which continues to create significant investor uncertainty. In response, the Chinese government is implementing sweeping domestic reforms focused on stabilising the economy, curbing excessive debt, and securing sustainable growth. These internal priorities necessitate that liquidity is kept within the domestic economy rather than being deployed to purchase foreign assets like US government bonds. The convergence of this deliberate diversification and pressing domestic pressures leads to a singular, inescapable conclusion. China is now either unwilling or unable to act as the buyer of last resort for US debt markets. Politically and economically, it can no longer be relied upon to guarantee stability by purchasing vast quantities of US government bonds. This represents a fundamental shift in the global financial order. Major economic powers are increasingly prioritising national economic priorities over international financial obligations. The combined effect of a strategic move away from the dollar and acute internal challenges is why US Treasury markets are now entering a prolonged period of uncertainty. The era of automatic Chinese support for US debt is over. The consequences of this realignment are profound. As China and other major holders reduce their purchases, US government borrowing costs are projected to rise. An increase in Treasury yields acts as a benchmark, setting off a chain reaction throughout the entire financial system. We are likely to see mortgage rates climb, placing home ownership further out of reach for many. Consumer loans for cars and credit will become more expensive, and businesses will face higher interest on corporate bonds, inevitably slowing investment, hiring, and expansion. Globally, bond markets will experience significant volatility. The withdrawal of a traditional buyer of China's magnitude creates deep uncertainty, prompting other investors to reassess the safety and stability of US debt. This could trigger sharp swings in bond prices, creating ripple effects through stock markets and all financial instruments tied to interest rates. Ultimately, this challenges the US dollar's very role as the world's primary reserve currency. If major Treasury holders continue to diversify away from the dollar, global confidence in the currency will waver. Nations and institutions that have long relied on US debt as a stable anchor for the global financial system may begin shifting their reserves into other currencies or assets. The unassailable dominance of the US dollar is now facing its most serious test in decades. The ramifications of this financial recalibration extend far beyond the dealing rooms of Wall Street and city trading floors. This is not merely a market story, it is a geopolitical one, with profound international implications. We are now witnessing a global reassessment of what truly constitutes a safe asset. International investors are actively diversifying, moving capital into gold, other sovereign bonds, and alternative currencies. This shift threatens to disrupt long-established trade flows and global investment patterns. Nations and corporations reliant on cross-border financing will inevitably face higher costs. Emerging markets in particular are exposed. They are likely to feel acute strain as capital becomes more expensive and dangerously volatile. The combined effect of rising US borrowing costs, sustained bond market instability, and a potential diminishment of the dollar's dominance has the capacity to reshape the very architecture of global financial stability. The impact will be felt not just by investors and governments, but by everyday people, for whom every major economic decision, from a mortgage to a business loan, becomes more expensive in an increasingly unpredictable world. Looking forward, we can map out several plausible scenarios. In the first, the United States successfully courts new buyers for its debt. Other nations, large institutional investors, sovereign wealth funds seeking long-term returns. Should this demand stabilise, the Treasury market could steady itself, interest rates could be contained, and the broader economy might avert a severe disruption. This would restore confidence, contain the ripple effects on lending, and allow the US to maintain its central economic leverage. Global markets would, without doubt, breathe a collective sigh of relief. A second, more concerning scenario involves a continued sell-off, a persistent refusal by China to participate. Should Beijing and other major holders scale back their purchases aggressively, we could witness a rapid spike in interest rates. The consequence? Borrowing costs would surge across the board, from home loans to corporate debt. Consumer spending would likely slow, business investment would be delayed, and government financing would become significantly more expensive. The shockwaves would extend globally, triggering volatility across bonds, equities, and currencies. Nations that use US debt as their financial benchmark would struggle to find a viable alternative, thereby amplifying the economic strain worldwide. The third scenario hinges on diplomacy, a strategic deal struck between Washington and Beijing. Such an agreement would involve compromises and concessions, perhaps financial incentives to encourage continued Chinese purchases or to restore market confidence. This could involve adjustments to trade policy, tariff reductions, or coordinated financial planning. If successful, the US would secure a temporary lifeline, slowing the rise in interest rates and restoring a measure of predictability. While underlying uncertainties would remain, such strategic negotiations could prevent a full-scale market disruption and demonstrate that the United States retains the diplomatic capacity to navigate this complex economic relationship. Each of these potential futures carries significant implications, not merely for the United States, but for the entire global economy. The choices of major debt holders, the reactions of the international investment community, and the ultimate effectiveness of American economic diplomacy will collectively determine the next chapter for financial stability, interest rates, and market confidence worldwide.